Let's start today, though, with the market and the impact of rising bond yields. While market history shows stocks tend to rally into the end of the year, the sell-off in bonds and rise in yields has put a damper on what has been a strong year for equity markets generally. So what does it all mean, and where do we go from here? Let's bring in Dryden Pence, Chief Investment Officer with Pence Capital Management. Also with us, CNBC contributor Sarat Sethi, Managing Partner with DCLA. He is our guest host for the hour. Welcome to both of you. Good to have you here. Dryden, let me begin with you with your thoughts on bonds generally. There's been some talk. I mean, lately you've been paid to keep your maturities very short, whether you're in the Treasury market or elsewhere. Are we getting to the point where it might be time to go out a little farther on the duration curve?
Well, I think that people are beginning to realize that the interest rate regime is now going to be higher for longer. And therefore, those people who've been very, very short can begin to move out just a little bit because yield curves normalize. We're in this situation where we're now have gone from very inverted to closely to flat. And I think that the realization is that this movement from higher to longer is going to allow people to move out a little bit on the yield curve because, quite frankly, the idea that we're going to have a massive move down in 2024 is probably certainly off the table.
Sarat, what do you think there? Are we getting close to the moment where you would think about going out and lengthening your maturities if you hold bonds?
So I would be careful with how far out you want to go. I think 3 to 5 years can work, but you have to be very careful about credit quality if you're talking about corporate bonds. And I think we haven't really seen spreads blow out, meaning we haven't really seen stocks, balance sheets reflect some of the refinancing coming, some of the higher rates, and a potential slowdown in the economy because that's what the end result is going to be of all this tightening. So when you do go out 3 to 5 years, make sure that the credit that you're holding is of high quality and not cyclicals and not companies that are going to have to go back to the market very shortly or that are depending on advertising. So just like when you do stock picking, you got to be careful on the bond picking side too and know that your spread, the difference between the Treasury and what you're getting paid for is commensurate to the risk you're taking.
Some people might say or might argue or might think, well, I can't do that work. That's how I would feel as an investor. How would I possibly know? So would I be safe enough buying, some kind of broad exposure and hoping that even if I lose 10 or 20% at the margin because of defaults, I still might come out ahead?
Yeah, and I think that's when you get a short-term diversified bond fund for that amount. But you have to be careful because it does have volatility. So it's, we prefer owning the individuals, but
Totally.
To your point there, or if you don't think the risk is enough, just buy a short-term Treasury fund or something to that effect where you're not taking credit quality.
Do you think people should go into their Fidelity accounts, just look for Apple bond CUSIPs and just load up on that? I mean,
well, so the spread over Treasuries, is not that commensurate to take the risk.
True.
Apple's not going to be out of business, so that's kind of where you're going to have to play that amount. But an A-rated, highly B-rated companies that are 50, 60 over 60 basis points over the Treasury, those you can be comfortable with. So you can do it with high-quality companies. Just don't go into companies that think, I'm getting 9% for 2 years. Well, the bond market is normally more right than the equity market, so it's telling you something that probably much more risk there than there is.
Dryden, what do you think of stocks and the so-called earnings recession that we may have just exited?
Well, I think the earnings recession is over, and we looked at, you had the Magnificent Seven the first part of the year, and now we're looking more towards the 493 because the earnings recession is pretty much over. You're going to see continued growth in earnings throughout the market that we believe through the end of the year and then into next year. So I think the economy is fairly strong. It's going to continue to be that way, and I think that's going to be supportive for the rest of the market, that 493, to begin to have increase in earnings. And we think the recession's over. I mean, the Magnificent Seven ended their earnings recession 3 or 4 quarters ago. Now the rest of the market is doing that, and we can move forward to, we think, a pretty broadening, more positive, more strengthening value of prices.